Hey, Dan Passarelli here. How you feeling today, friends? All right. Good, good, good. I'm glad. I can feel that you're feeling good. I want to make sure you can hear me. Please go to that Q&A box and let me know that you can hear me. Hit that chat box, Q&A box, whatever it is. Danny, oh Danny boy. Fawn is back. Justin is back. Mike is back. We got Giorgio. Juan is back. Yi is back. Oh my gosh. Tomas is back. Shane is back. Excellent. I'm glad. I'm glad you're back. I'm glad I'm back. I'm glad we're all back because we've got great stuff to talk about here today. Today we're talking about MOMO trading with options. How to trade momentum. All right. Hey, Larry's here. We can't forget Larry. Hey, what's up, man? Good to see you. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is providing generalized information, not specific to your particular situation. Now, clearly, we've got some returning friends here, but I saw a couple of new names there as well. So, for those of you who are not familiar with me, where you been all my life? Come on, man. Allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the top option trading books. Trading Option Greeks is the one I'm most known for. And I am a trader. I traded as a professional down on the floor at the Chicago Board Options Exchange and the Chicago Board of Trade. Now part of the CME group. I've been all over the Chicago landscape of option trading. Now I trade in a retail account just like you, and I do it every day. And I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have trained student traders in over 50 countries. You believe that? Isn't that crazy, man? It is crazy. But we've been doing it for a long time. We started in 2008. What is that? 17 years now? So we've trained tens of thousands of traders and investors. And I am a collaborator within the trading industry with all the good actors out there. I've worked with, collaborated with, consulted with, worked for basically all the options exchanges in the world. I can't think of one offhand that I didn't at least have some small role doing something with. And just about all the quality options brokers out there as well, just like Firstrade. If there's a brokerage firm that has a good option trading offering, I worked with them. And the important thing next, my family. I am a family man, if you will, married to my wife, Kathleen, who those of you who are market taker student traders, like Larry, for example, among others of you, you're familiar with Kathleen. She runs operations here at Market Taker Mentoring. And we have our two adult children who just moved out of the house. They actually both have already moved out of the house, but for those of you who have not had adult children yet, maybe you have small kids, you are in for a treat. They just keep coming back, which you're probably glad about on some level. I was glad about on some level too. I was kind of sad for them to move out again a second time, but they moved in together. So when we visit them, it's one-stop shop, and they're only like an hour away. And then I've got my two little doggies. Some never leave. Oh boy. So they might even come back again. They know where to find us. That's for sure. And then finally, I do other things for fun besides trading. I'm a runner. I was out running this morning, although my foot was bothering me a little bit. I had to walk a lot. I don't like doing that, but I did. I'm a foodie, love to eat good food of any sort, and traveler. Been all around the world with my family or with Market Taker with my options career. And me and my family were music people as well. So that's who I am. But enough about me. Let's talk about the important person here. That is you. Today, we're going to talk about trading momentum, MOMO trades, some big Mo trades. And so, in addition to everything we cover here today, I've got something else for you, a little treat for you to further your knowledge on trading momentum. Go to markettaker.com/big mo. Big Mo, BIGMO. Market is in stock market. Taker as in take what is rightfully yours. That is two T's in a row. Markettaker.com/big mo. And grab this free strategy guide. I think you're going to like it. So let's talk about momentum trades. What are momentum trades anyway? Well, momentum trades are when you see a stock moving up or down, a lot of times it's got some momentum to it, right? And if you can jump on that momentum while the momentum is building, you can pick up on part of that trend and make money on it. So this is a technical trading technique using a stock chart and tools revolving around the stock chart, maybe scanners that enable you to scan for certain patterns, as opposed to a fundamental strategy. So let's talk about some of these tools. The intent, by the way, of this class is not to teach technical analysis. We're going to talk about some of it. I mean, we kind of have to. But presumably many of you already have some technical indicators that work well for you. I found that technical analysis is very personal. But let's talk about some here that happen to be some of the ones that I personally follow and use and provide value to what I do. And after that, my intent today is to discuss the next step in your trading plan and the one in which most traders run into trouble, and that is implementation. There are a lot of traders out there who are good at technical analysis, but option trades that are destined to fail because they overlook some important details of the trade itself. Many times, these traders call the market right, but still lose money because they made an option trade that wasn't set up properly. Sometimes these trades are buoyed by time decay, sometimes the volatility component of options. And so there's a lot of other things we need to look at. But let's talk about some of these tools and indicators first. First of all, scanners. Scanners can save you a lot of time, and there are many that are out there. I have actually created one just to make it super easy called the RKO GKO, which is short for red knockout / green knockout. But there are others out there too. And there's some preferred indicators that we can use for momentum as well. Moving averages is a big one, especially when it comes to moving average crossovers. When the short-term moving average crosses above well, technically above or below a longer-term moving average, that can be a signal that there's some momentum going on and building. The MACD, moving average, that measures moving average crossovers. That's the MAC. ADX/DMI. RSI, that's the relative strength index. That's a real favorite one of mine. But once, like maybe you already use some of these, and maybe you're good at some of these, or, maybe you don't use these yet and you need to hone your skills with them. Either way, there's more to it than this. Either way, you've got to be able to properly set up an option trade. And so I've come up with this thing that I call the MTM trading path. And it is a system for trading any type of option position. Today, we're going to talk about it in context of momentum trades. But these are the steps that you follow on every single option trade out there. And those of you like Larry and Juan, I think you're a market taker student as well, if I'm not mistaken. And I know there's some other ones of you out there. You've seen this before. This is a big, big, important thing for what we do with Market Taker. So we start out observing the market. Do we look for momentum trades directly? I mean, we could, but we don't necessarily have to. Sometimes you come up with a momentum trade accidentally. You could be looking for a neutral trade to trade a time spread or iron condor. And you're like, oh, geez, this is not a neutral trade at all. Look at how trendy it is. It's like really just going up like crazy. There's a lot of momentum to it. Wait a minute. This could be a good trade for trading momentum. And when we observe, we discover opportunities. At this point, we don't have a trade yet. If we see a stock or ETF that's really just climbing, that doesn't mean necessarily it's a momentum trade. It is an opportunity, a potential opportunity for a momentum trade. So what we would do is we would analyze the technicals. We would look to see that there are higher highs and higher lows. What does that mean? Here, let's take a look. Told you this wasn't really going to be a technical analysis teaching day, but I think you're going to benefit with a little bit of that. So let's do a little bit of that. We're going to go. Let's just do it up here. We look at spiders, SPY, for what period is this? Let's just look for a year. And let's make sure we're on 1-day candles here. Oops. Oh, Jesus. Oh, there it is. Sometimes a spaceman. Okay. Well, it doesn't matter what period we're looking at it for. This is here. We're going to swoosh this a little bit. There we go. That's what I was trying to do. So this period here, I mean, this is the definition of momentum. And, it starts by considering that this is a trend. And how do we define a trend? There's really one good solid definition for a trend. And if you're taking notes, this is a good thing to write down. A trend consists of higher highs and higher lows. So what do I mean by that? Well, look, we got up to, we hit this bottom here and then we started retracing back and then we got to here and it became a high. Well, this high is higher than this kind of weird high over here. But then, a couple days later, it made a recent low. But this low is higher than this low, and it's higher than this low, and it's higher than this low. It's a higher low. And then, oh, look, we made a new high. It's a higher high than this high. And then there's a pullback, and we made a new low, very short-term low, and it's higher than this low. It's a higher low. Higher high, higher low. Higher high, higher low. Higher high, higher low. So that's a trend. That's not necessarily the definition of momentum, but a trend can be part of that. And then we're going to look at a lot of technicals. There's a really nice technical setup that I call the RKO, the red knockout, that I'll show you, I think later in this. Yeah. Oh, yeah. I've got some good stuff to show you. I'll show you that later. And that's also in that strategy guide that I gave you. We're going to look at fundamentals, which, some people love looking at, all the financial ratios and that. That's a skill in and of itself. And a lot of option traders, especially momentum option traders, don't necessarily look at all those financial ratios because those are typically for longer term investments, not short term trades. But we might look at things like when is earnings? That's kind of like a fundamental analysis. Because if earnings is like tomorrow, I mean, we could have a big gap either way. It's no longer really a momentum trade, then it's an earnings trade. And the options could be really expensive then. Then we look at volatility, which, by the way, is a good way to see if the options are really expensive. And then we state our forecast. The forecast isn't, like, I'm going to give you an idea of what a forecast is. A forecast isn't, well, I don't know, looks like it's kind of going up. That's not a forecast. A forecast is something like, and I'm making this up, okay? Like, this is not my forecast, but I think over the next 2 weeks, this ETF can go up another 5%. It's just hypothetical. I don't think that, but. And if it does, I think implied volatility will fall by 2 points. That is a holistic forecast, not just direction, but the degree of the direction. How much do I think it'll go up or down? Time, over what period of time? And because we're trading options, consequently, what volatility behavior will we see? But implied volatility goes up or implied volatility goes down. We always need those 3 elements in our forecast. And then we state a proper forecast. And that's important because that guides what strategy we select. I mean, if I'm bullish, I could buy a call. But which one? In the money, at the money, or out of the money? Depends. Or I could buy a bull call spread. Which one? In the money long call, at the money long call, out of the money long call? Where's the short strike? I could sell a put spread. I could do a lot of things. The forecast drives the strategy. Then I plan my exits. I implement the trade. I monitor the position, make my adjustments, my exits, and then I do a post-mortem. I learn from the trade. Okay, so I said this before. Our forecast consists of the degree of direction of the underlying price, which is measured by delta, over what period of time, because I'm either going to make or lose money on theta, So I need to think about what period of time. And implied volatility will change. And so I'm going to make or lose money on delta, theta, and vega. So I need to account for each of those things to construct a strategy that is I optimized for each of those things. So one of the momentum trades that we can do is just slow and steady movement. So like spiders here, this has been slow and steady movement since April 3rd, which is this date, or April, 3rd. How do I remember it's April 3rd? Because that's my birthday. Mark your calendars. I'll send you my address so that you can send me presents. Remind me to give you my address later. It's, the birthday already happened. We're like a third of the year past my birthday. But the good news is you get a lot of time to plan for what to get me for my next birthday. Cash is nice, gift cards. I mean, new car would be great, but I don't want to be presumptive or anything. All right. So anyway, this is a slow and steady type move that since the April 3rd tariff thing, it kind of had this volatility period and then slow and steady momentum up, up, up. So how do we trade that? Well, the slow and steady momentum, the best way to trade that really is we want to trade that momentum trend with leveraged directional exposure and limited risk. Because look, if we're going to buy a call, which is what we're talking about here, leveraged directional exposure with limited risk, that's an in-the-money call. Why is it leveraged directional exposure? Because in-the-money calls act kind of like stock. They have a big delta. And so instead of buying the stock, we could buy a couple of in-the-money calls and make even more if we're right. Lose more if we're wrong, but only to a point. So what are the hurdles with the in-the-money call? Well, one of the hurdles is time decay because we're buying options. We're buying a call. It decays in value. But in-the-money calls have less time premium and consequently less time decay than at-the-money calls. In-the-money calls are made up partially of intrinsic value, which does not decay in value. Only time value decays. So that's why in-the-money calls can be an advantage. Also, another potential hurdle, and this is a potential hurdle, is volatility, specifically implied volatility. Because, why? Because with most stocks or ETFs, not all of them, but most of them, with most stocks or ETFs, when they go up, implied volatility does what? Goes down. There's an inverse relationship between the direction of the underlying and the implied volatility of their options. Stocks go up, implied volatility goes down. So if you buy a call, you make money on delta, but you're going to lose some on time decay. We lose less with the in-the-money call. And you're probably going to lose some with implied volatility going down. But we lose less with the in-the-money call because the vegas are smaller with in-the-money calls. The in-the-money call enables us to optimize our Greeks. It gives us a big delta that we want and low theta and low vega that we don't want. Okay? This is in comparison to at the monies. So here's an example, and this is hypothetical. On stuff like this, I say price is not current. Example is for illustrated purposes only. And that's not because of some legal thing. I mean, yes, I think the lawyers want me to say that, but it's for real. This is a screenshot that was from a while ago. Not a super long time, but a long enough time. And it is only for illustrative purposes. In fact, I don't even tell you what stock because I don't want you to think it's a recommendation. I am trying to teach you to empower you. I want you to be good at trading, not necessarily reliant on me, to be good at trading yourself so that you can spot these things and have a skill that you can potentially make money with. So on this stock, it's probably got one of those slow, steady grinds higher, like I showed you in spiders. There's a trader who thinks the stock will rise pretty sharply from its current value of around 137.90 over the next 3 weeks. So 3 weeks, that's a slower, steadier grind. What we might consider doing is buying these longer term calls. You know, these calls might have like 3 months or something until expiration. Now you might say, wait a minute, Dan, you said in the forecast that you expect the move to happen in 3 weeks. Why would I buy a 3-month call? Did you say the wrong word? No. When we're buying calls, we always want to buy more time than we need. Why? Well, because as we get closer to expiration, options that are, you know, kind of nearest to the money, which, you know, could happen here, they decay more in value. So if we buy more time, we get a smaller theta. And let's talk about the strike for a minute. The stock is at 137.90, but we're looking at the 125 calls. So these are in the money by what? At least 10%, right? So the reason why that can be a strong trade is because all we really want to do is trade direction, delta. We don't want time decay. We don't want volatility. So let's talk about this. I'm throwing this word out, delta, assuming everybody in the world knows what delta is, but I know everybody in the world doesn't know what delta is. I know what it is. Some of you know what it is, but everybody doesn't. You're not born knowing what delta is. You learn what delta is. So let's talk about what delta is. Delta is the rate of change of an option's price compared with the underlying asset. So I know that if a stock or ETF goes up, the call goes up, right? Well, how much does the call go up? If the stock goes up 20 cents, does the call go up by $10? No. It goes up by a percentage of that move, less than 100%. So in our example, if I buy 10 of these December 27th, 125 calls at 1570, what if the delta is 85. What does that mean? It means if the stock goes up by $1, the call goes up by 85% of $1. What's 85% of a dollar? Well, it's 85 cents. And we always use the example, if the stock goes up by $1, the call goes up by the amount of the delta. But think about it in terms of percentages, because when you're really like in the weeds doing this, you got your calculator out. If the stock goes up by $1.27, you're going to have to multiply that times 0.85. So think about it more as a percent. So the delta is big. The delta can only be 100%, 1.00. The call cannot move by more than the stock price as far as delta is concerned. So this is a pretty big delta. At the money deltas are going to have like a 50% delta. They move half as much as the underlying stock. So this is a big delta. Well, what about theta and vega, time decay? Well, theta is what? The rate of change of an options price as time moves forward. For every 1 day that passes, options decrease in value by the amount of their theta. So here, the theta is 0.06. What the heck does that mean? Well, 0.06 is 6 cents of theta. The option loses 6 cents a day. So if today the option is worth $15.70, all else held constant, this option will be worth $15.66 or 64, 6 cents less. Now I say all else held constant because this is where it gets, I don't want to say it gets theoretical, because theta is really not theoretical. I mean, it is, but it's not. One thing I can tell you is that tomorrow this call will not be worth $15.64. It will not be worth exactly 6 cents less, but that's because of a couple of factors. One is it probably only trades in nickels or dimes, not in pennies. So it'd have to be worth like $15.65 or $15.60. The other thing is the stock is not going to be exactly right here too. It's going to make or lose some money from delta, but it will lose that 6 cents of theta. And the implied volatility might change. So vega will affect it. What is vega? Well, vega is the rate of change of an options price compared with a change in implied volatility. Now, if you're scratching your head saying, what's implied volatility? We have done some Firstrade webinars on this. Please go to YouTube and search Firstrade. There's only one T in Firstrade. In markettaker.com, there are 2 T's, but in Firstrade, there's just 1 T. I borrowed that other T from Firstrade and put it in markettaker.com. And go and look at some of the webinars that I have done on implied volatility. There's some other folks that do webinars also, and they might have good stuff too, but I just know what I did, and I very specifically explained implied volatility. So please go and check that out if you need help on implied volatility. Okay, so look, we might think that a stock is going to rise over, significantly 5% or whatever, 10% over 3 weeks. But guess what? You are not going to be exactly correct. I have made probably 20,000 trades in my career. And I've been right on some and I've been wrong on some. But the ones that I've been right on, I don't know if I or any human has ever been exactly right on a trade, saying psychically, I predict that on this date, the stock will be at exactly this price. Never happens. So we need to think in terms of scenarios. What if this stock rises by like $1 today? Okay, so $1 is a small move, and today is a fast move. This is just like part of our forecast playing out. But this gets us into the mind frame of how to think about the Greeks, how they work. So let's start here. If the stock goes up by $1 today, how much will I make on delta? I will make 85 cents on delta. If it goes up today, well, one day doesn't pass, so I don't lose anything on theta. And if volatility is unchanged, I don't make or lose anything on vega. So it's just 1570 plus 85 is 1685. That's it. Okay, but that's not a realistic scenario. Let's look at a more realistic scenario. Let's say the stock rises $1 over 7 days, and consequently, because it's not moving much, it just went up a little bit, implied volatility falls by 1 point. Well, I'm going to make 85 cents on delta, and 7 days pass. So 7 days times 6 cents of theta is I lose 42 cents. And if implied volatility falls 1 point, I lose 9 cents of vega. So I make 85 cents, lose 42 cents, lose 9 cents. I still end up making money. Let's see, 0.85 minus 0.42 minus 0.09, make about 34 cents. This is going to trade in nickels, so we'll round that to 35 cents. I'm going to make about 35 cents. What if instead of an at the money or in the money, I did an out of the money? Or no. What if instead of an in the money, I did an at the money and the stock went up $1 over 7 days? Well, we just looked at what the in the money call looks like. What would the at the money call look like? Well, the delta would be smaller. It would only be about 50. So I'd only make 50 cents instead of 85 cents on direction. But the theta for at the monies is bigger. In this case, it's 12 cents. It's actually twice as big. So 12 cents times 7 days, I'd lose 84 cents. And the vega of at the monies is bigger too. Instead of 9 cents, it's 15 cents. So if volatility falls 1 point, I lose 15 cents. I actually lose money on this. Made 50 cents from direction because I was right, but I didn't take into account theta or vega. So even though I was right, I'll still lose money. So it's very important to trade these things the right way. Time and volatility, they're very important to work into your strategy or your forecast. The forecast enables us to use the right strategy at the right time. And that can mean the difference between making and losing money. Spreads can help us a lot too. Spreads can limit the cost of a trade, and it can limit our profit potential, but it can also make our profit potential bigger, actually. Isn't that strange? Let's talk about that. Spreads can be great for slow and steady momentum moves. Or, depending, they can just be okay. Spreads are not good for fast, violent moves. So, okay, momentum setup. Let's say We're identifying setups in a strong price trend, focusing on technical indicators and price action. So maybe like relative strength index or the moving average convergence divergence, which measures moving average crossovers. Basically, that's the kind of the key with those when they cross the when it crosses the line, when the histogram crosses the line. But we're looking for how moving average converge and diverge. And then other price indicators. So, okay, so let's look. We want to assess the speed and change of price movements. So typically an RSI below 30 suggests that the underlying may be oversold. An RSI above 70 suggests that it might be overbought. Now here at this point, it looks like it's kind of overbought. So this might mean this trend might be coming to an end. The trend is no longer our friend. But honestly, I always wait until when it's in overbought territory, I don't worry about it. I worry about it when it crosses down below that 70 line. And if it's below 30, I don't really worry about it either. I worry about it when it crosses back above the 30 line. That's when we can see reversal, when it breaks through the 70 or 30 line. And then the moving average convergence divergence helps identify buy and sell signals by analyzing the relationship between two exponential moving averages. So the MACD line crosses, when the MACD line crosses above the signal line, it is a potential buy. And when the MACD line crosses below the signal line, it is a potential sell. So and when we see these crossovers, that is where the blue line is the MACD line, the orange line is the signal line. That amount that they are converging or diverging from one another, that we can draw that in what we call the histogram. And when the histogram goes from green to red, that is where the signal line crosses the where the MACD line crosses the signal line. Sorry. Had a little frog in my throat there. So here we can look. The MACD line crossed below the signal line, and we got like, pretty good sell off. And then we're down in over, well, we're down here. But then once we see the signal line, or once we see the MACD line cross, or the signal line cross, when we see the blue line cross above the orange line, which is when the histogram swaps, that's when we see the momentum starts. How do we know when the momentum ends? It didn't end here. We just had a little bit of a pullback, really a buying opportunity. But here we see the lines cross. And so this ends up being time to get out. Now, here the trend kind of starts, but it's kind of a weak trend. This is really not a trend. This is really not momentum. This is largely just one big up day. And this was a doji. This is doji. This is doji. This was almost an inverted hammer. So we don't really see things happening until about here. And then there's buy and sell setups. A continuation of an upward or downward trend is what we're looking to have defined. When the underlying is in an uptrend, if it pulls back at least 2 bars or candles, and then the current candle crosses above the previous candle's high. So this is a 2 bar or 2 candle pullback. Once this crosses, once the pullback ends, and this candle crosses above, hold on a second here. Sorry, frog in my throat. Oh my goodness. So, I mean, this could be, a reversal of momentum. So like, look, here we got the 2 bar pullback, and then boom, this one crosses above the high. And it kicks off some momentum here, right? You get the 2 bar pullback, kicks off some more momentum. Breaks of support and resistance are very important when it comes to momentum plays. Support and resistance, which are levels that have kept the underlying from moving higher in terms of resistance or lower in terms of support, those have a good chance of remaining intact and preventing the underlying from moving. But once they're broken, resistance becomes support and vice versa. So like, oops, look, once there is resistance on a chart, in fact, here, let's just jump into the example. This is a resistance line. Once the stock got up here, it pulled back, and then it got up there again, and it pulled back. Got up there again, it pulled back. It's had a hard time getting above this level. But once it busts above it, that means the buy orders took out all the sell orders that were here. And so now there aren't sell orders holding it down anymore. And so we can get a short-term momentum move here, even a long-term momentum move here. And that brings us finally to the red knockout, which is I and John Kamisic came up with this one. We did a lot of research on this, and it works really, really nice. That's what's in that strategy guide that I gave you. Read that strategy guide. The red knockout is a 4-part setup. It starts out with the setup candles, which is 3 or more green candles that make up the green run. And then there is the red knockout candle, which is a red candle immediately following the setup candles with a smaller body. Then there's the trigger candle, which is a green candle immediately following the red knockout. It takes out the red candle's high on higher volume, ideally. And then there's the confirmation candle that opens above the high of the RKO. That's the one that signals trade entry. So let me break these down and give you some more detail around them. The setup candles, which I also call the green run, is 3 or more green candles that are up days. They're up days and they're green. In this case, we have 3. In this one here, we actually, so we got 1, 2, 3, 4, 5, 6. All these candles are green. What does a green candle mean? It means that the stock closed higher than it opened. So it opened here, closed up here, open 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 here, closed here, open here, closed here. And this here, this little one here, I think is just a little glitch. So let's just ignore this one. Okay. But that's not necessarily an up day. An up day means that it closed higher than yesterday's close, which all of these did too. Close here, next day it closed higher, next day it closed higher. closed higher, closed higher. It's possible to have a green candle that's a down day, like this one right here. It opened, so like yesterday it closed here. It opened way lower. It went up during the day, but not above yesterday's close. So green candle and update are two different things, and we need them both. Then we have the RKO candle, which has in a perfect world, it has a smaller body than each of the preceding green candles, which, yeah, I mean, this one's not a perfect example, but, you know, it has a smaller body than most of them. But what this means is, sure, it opened higher, but it pulled back during the day. Within every momentum trend, we need a pullback. Otherwise, the trend just burns itself out. We need a day where whether the stock opens higher or lower, and it doesn't matter. But during the day, some people are taking some profits and giving people who didn't get in an opportunity to get in and drive further momentum. And then there's the trigger candle. All these candles are all consecutive. The trigger candle, at some point during the day, trades higher than the RKO's high, which we see here it did, right? Trade above here. Now, notably, this one opened down on the day. It opened lower, but the buyers got back in and drove it higher, and it ended up trading above the RKO's high. And then finally, we just need one more candle. This is the confirmation candle that opens above the high of the RKO, and that signals the trade entry. So as far as which options to select, if we see an RKO, we want to buy calls, and we want to buy the call that has a 65 to 35 delta. Now that's a pretty big range, which A, gives you a little bit of flexibility in a lot of cases, but B, I mean, a lot of times on some of the less liquid names or when there's fewer strikes, there might only be one choice of an option that has between a 65 and 35 delta. So that's what we want to do. And we also want to choose an option that expires with enough time for the trade to play out. We don't want to be choosing the one that expires tomorrow. We don't need to choose one that expires a year from now. But we want to choose, I mean, the ideal one we want to choose is in the monthly expiration cycle with at least, 15 days until expiration. Why the monthly expiration cycle? Because like, look, this stock has weeklies, right? We have options expire on July 3rd, July 11th, July 18th, July 25th. That's once a week. But July 18th, August 15th, those are the monthly expirations. Why are the monthly expirations powerful? Because they tend to have tighter bid-ask spreads than the weekly ones. They will have been around for a longer period of time. So there's more open interest, more volume, which means more trading, which means tighter bid-ask spreads. So these, gosh, man, I covered a lot. I really gave you guys tons and tons of tools and resources. And that's pretty darn great, isn't it? And don't forget this tool/resource if you came in late. Go to markettaker.com/big momentum and get this strategy guide that will highlight some of the things that we talked about today, particularly with the red knockout. And little Easter egg bonus for you. Those of you who go to markettaker.com/bigmo and download the strategy guide, you will also get an invite to a special webinar on the topic. So do that. And friends, that's all that we have for you for today. Larry says great stuff as usual. Thank you, sir. Much appreciated. And friends, I will catch you next time next week, where we're going to be talking about planning your exits for option trades. Oh my gosh, that is such a hugely important topic. So that's what we're talking about tomorrow, or not tomorrow. That's what we're talking about next week. Can you re-attend the webinar? Sure. Go for it. Juan, you're welcome, my friend. Catch you next time as well. Yee, you're welcome, my friend. Catch you next time as well. Have a great week. See you next week. And in the meantime, trade smart.